Normally, the monetary policy concentrates on inflation and growth, but this time it may have to concentrate on liquidity. What do we mean by that? On a daily basis, banks are going and giving the Reserve Bank 7 to 8 lakh crore at the reverse repo window. Now, this amount of liquidity is not the only problem. Outside the banking system, even mutual funds have got about some 5 lakh crore because they bought treasury bills in the first half, which the government had floated, and now those bills have matured. So MFs also, mutual funds also have a lot of money. Normally, why do you have a repo rate? The MPC, Monetary Policy Committee, fixes the repo rate in the hope that every other yield in the market should trade above it. Already in the last 6 months, it's not repo, but the reverse repo, the rate at which RBI takes money, which has become the operational rate. But in reality, even that is not the minimum. A lot of rates are, overnight money, banks are exchanging with each other at 115 basis points below repo or at 50 basis points below the reverse repo. That is the overnight exchange of money between banks. Treasury bills, 3-month bills, are trading a good 0.25% below the reverse repo. If you thought that was only government paper, wait. Even corporates through commercial paper and banks through certificates of deposit are getting money below 3.35. You can take a 3-month loan below reverse repo rate of 3.5. You can get it at even 3%. That is the level to which liquidity is creating problems. And this is because of the excessive amount of dollars which RBI is buying. RBI is buying dollars because it doesn't want the rupee to become expensive. Then India will become uncompetitive. It has bought $97 billion since April. And if you multiply it, that means it has put in around 6 lakh crore into the system by buying dollars. And this is expected to continue in the second half also. It is also buying bonds, but not so much. If you take the September-October period alone, since the last policy, they've not bought much, but 40,000 crore of government bonds, central government bonds, about 20,000 crore of state government bonds, and then they've done something called a switch. They buy up the longer term bonds, which no one wants, and gives shorter term paper to keep yields down. But it's not done much in the bond market. The point is that they may have to continue to buy both dollars and bonds, which means they have to keep increasing the liquidity in the system. Now, this creates a lot of problems. Excess liquidity creates a problem of mispricing risk. When a bank has so much money and all that they get is, 3% if they put it in T-bills or 3.3 if they give it to the RBI, what will you do? You will give it to anyone for 5%, 6%, 7%, and they may not be people who are very good. It may be a bad project. So the danger of mispricing and bad loans at a later stage are very high when you have so much liquidity. The other problem, of course, is inflation. When you have too much cash and not enough goods and services, that also leads to higher prices, which we are seeing, of course, in some cases. So what does RBI have to do? RBI's problem is that it has to pull up the short-term yield to at least the reverse repo level. How do they do that? One way they can do it is to allow the mutual funds and insurance companies also, if they have excess cash lying around, instead of giving it to the wrong people at the wrong rate, give it to RBI at 3.35. At the moment, only banks can do it. So they can throw the door open. They can also do another thing which is already available as a concept, the standing deposit facility. Every time the Reserve Bank takes money in the reverse repo window, it has to give bonds, but it has a limited amount of bonds. In the standing deposit facility, they don't have to give any collateral. The Reserve Bank can keep unlimited amounts of money at, say, 3.5%. They could do that. They could introduce that concept. And of course, they can do the Brahmastra. If you please, they can increase the CRR. The CRR was cut last March, and it was supposed to be rolled back only in next March. They can start rolling a little bit of it earlier, increasing the CRR. But all this has to be done very delicately. Now, let's not forget, the Reserve Bank has its biggest task is to control inflation. Inflation has to be kept according to the law between 2 and 6% by the MPC. That's their mandate. But look at it. For the last so many months, inflation is above 6%. In fact, in October, it's above 7%, and that's likely to be the reading in November as well. Basically, it's a food inflation problem. Look at the numbers, September, October, running at double digits. But that's not all. You can explain away food by saying, okay, supplies were bad, but core inflation is what you pay for tuitions, medical services, service inflation. Even that is running at close to 6%. So, Reserve Bank can't ignore it. And then there is a third problem. Global inflation is also picking up. Look at commodity prices. Copper at 6-year high, aluminum at 3-year high, nickel at 1.5-year high. This year, central banks have printed so much money, it has increased the prices of equities, it has increased the price of all commodities as well. And not just metals, it has also increased food prices. Corn prices, 16-month high. Sugar, that's a very big part of our CPI, that's at a 9-month high. Global food inflation can very easily seep into ours, or at least it can prevent our inflation from going down. That's on inflation. The third problem is growth. You may say that is a slightly less of a problem now because the second quarter growth was not as bad as we thought. Therefore, a lot of people have reduced the extent to which the economy will shrink. Nomura expected the economy to shrink by nearly 11%. Now they say the shrinkage is likely to be 8%. But it is still a shrinkage. Okay? A lot of brokerages have reduced the extent to which the economy might shrink. RBI had forecast in the September policy that the Indian economy will shrink by 9.5% in the current year, and second quarter itself they had said it would shrink by 9.8%, and then they reduced it subsequently. They said it will fall by 8.6%, but actually GDP has not fallen so much. So there the Reserve Bank has some reason to sound positive. Has it? No, not if you looked at the November numbers. November auto sales, not as good as October. November PMI, not as good as October. In fact, that's a 3-month low. Power consumption, rail freight, so many are not as good. So the point is you can't extrapolate the second quarter growth very easily into Q3 and Q4. Hence the great balancing act. RBI has to balance growth as well as inflation. Growth is not out of the woods. It needs the help of lower rates. At the same time, inflation is high. It could get higher because of global factors, and liquidity can make a lot of mischief. It can push up inflation. It can lead to financial instability by going into mispriced loans. Now, the point is Reserve Bank has to communicate one big thing. A liquidity policy when the economy was at minus 24 in the first quarter cannot be the same 1 year later when the economy is expected to grow by 20% in Q1 of next year, April, May, June of next year. So how will it communicate that? That is its big problem. In September, it said we are going to remain accommodative, that is, keep rates and liquidity easy up until 2021. So now it has to roll back this liquidity in the next 6 months and say that there are no more rate cuts left, but do all this without pushing up yields too much. That's not an easy task. So let's see what the Reserve Bank does on Friday.